It's an email from Paul. The subject is Inter Pipeline. Does he own it? Would he be buying it at these prices? And maybe a comment on the pipelines as a whole.
Sure. So, Andy, people who've been watching a while will know that between sort of 2009 and 2014, we were big sort of proponents of energy infrastructure. Not just because the yields were good, but because of fracking and because of the acceleration in the production of oil in North America, the pipelines, which are essentially toll roads, had this wonderful growth and acceleration in tolls that they were charging. And so not only did you get your dividend, you got some dividend growth, and more importantly, the market was willing to pay a higher and higher multiple of earnings as they grew because the future looked brighter and brighter. Mm-hmm. And I think that what we've come to realize is that with certainty drilling holes, the likelihood, the ability to get capital is high for companies that are trying to grow their production. Mm-hmm. So as a result, we wind up very quickly with sort of overproduction in certain areas, right? So pricing power is not as strong for the energy companies today as it was years ago because when demand picks up, they can turn on production quite quickly.
Particularly in Canada.
Right. Well, in Canada and in the U.S. Now, in the case of Interpipe, you're banking on growth and supply coming from the oil sands. And the reality is that in general, in energy infrastructure, multiples are now contracting because you have less certainty of growth in the future. And so people aren't willing to pay as higher multiple. And so as a result, they're kind of underperforming. Now, historically, pipelines trade a lot like bonds. They're sort of a bond proxy. It's a long life asset with a stable revenue stream. And because bond prices are pretty weak, things that act like bonds are underperforming. So I would put them solidly in the have-not camp right now.
Wouldn't be keen on the pipelines.
We aren't keen on pipe, utilities, telcos, REITs, the things that were defensive that people hid in when the economy was uncertain. I prefer things that are more economically sensitive right now.
Dorothy in Mount Hope, go ahead, please.
Good afternoon. I'm retired and on a fixed income and manage my own portfolio. Listening to BNN, I have the impression that blockchain is the technology of the future, and I really don't understand how it works, but I wondered if it would be a good investment. And if so, what would your advice be of a way investing in blockchain on the TSX or the U.S. exchange? I have got some great advice from you in the past, and I really appreciate it. So. And I also wondered if you're invested in blockchain. Thank you.
Okay. Thanks, Dorothy.
So, Dorothy, I'll give you a sense for my thoughts on this. First of all, blockchain is a basic technology that will allow an asset's ownership to be tracked, and the ownership is sort of recorded on several different ledgers out there in the internet. And so it's a means of taking out a middleman to try and track ownership. Now, we are very early days in blockchain, and knowing where and how this is going to be deployed is very difficult to identify. So, being that it's so early stage, you have to assume that maybe there's a lot of risk in making bad decisions. So, I'll tell you, even though we run one fund, which is a small mid-cap fund that invests in earlier stage technologies, even we have only a relatively small investment in companies that are in the blockchain area. Now, when you tell me that you're, retired and on a fixed income, mm-hmm. This is probably not the type of thing that you want to focus on unless you can find some way to, in a small way, invest across a basket of securities. And I'm not sure that I would recommend one or two to you.
I'm just seeing, David, very quickly if I can find a blockchain ETF. I'm having a little bit of slow.
There's one that's just been launching in the U.S. But again, I think it's very early stage. It's going to be very, very volatile. I think I would probably not be recommending one to you.
Darrell in Winnipeg, go ahead, please.
I understand you run stops on all your positions, and I'm wondering with that sell-off in late January, early February, do you adjust your stops because it's a broad sell-off, or did you get stopped out on numerous positions because of the sell-off? Or I'm just curious to what your thought process is
Sure.
when you have it across the board sell-off. Thank you.
Sure. So Daryl, so I run some indicators that track breadth in the market, and on the 28th and 29th and 30th of January, all of our short-term indicators turned more defensive. So in general, that means we're actually less tolerant of downside than more. Now we run stops on all of our positions, and we identify our stop losses using point and figure price charts, which basically identify when the historical behavior of a security begins to change. So if it's been in higher highs and higher lows, and it stops that price pattern, goes into lower lows and lower highs, that's where we would exit and stop our way out. As it turns out, that sharp correction in the beginning of February, when our short-term indicators turned down, we put index hedges in the portfolio to reduce our exposure to equities by about 50% across all of our portfolios. That was just a macro call. Mm-hmm. At the micro level, at individual securities, we actually got stopped out of very few securities. Because if the market pullback was, 8.8% in the S&P, close to close, many of the securities weren't nearly that much. And we know that securities pull back in price. We aren't using stop losses 2 or 3% below the market, which wouldn't be very reasonable. Mm-hmm. So we lost a very small number of positions. And the hedges cut the market pullback by about a half. Mm-hmm. And we took those hedges off at February the 9th. At this point, we're quite bullish. So what's interesting is the leading sectors going in had less impact than the sectors that were lagging going in. So one of the reasons that the pullback was sharper than people expected was there's a lot of investors who own equities and own bonds, and they assume if equities go down, the bonds are going to go up. That's what happens when rates are falling. But it turns out rates have been rising, and so when stocks sold off, bonds sold off too.
Mm-hmm. Yes.
And that sort of freaked some people out, and so they wound up selling on both sides. But realistically, the leading stocks, very few of them broke down in price.
Just on the blockchain ETF, maybe I could ask the control room to put up, I think it'd be just a one-day chart for Link, L-I-N-K. Because apparently the plan was Evolve Funds Group launched that, and they plan to list this yesterday on the TSX under the symbol L-I-N-K. And the idea with that one is to invest mostly in stocks of companies involved in blockchain. I'm not sure we can have a quick look at LINK, but as you say, David, you feel it's a pretty volatile area.
I'm not saying there isn't money to be made, but we're focused in very small pieces of a number of companies, mm-hmm. and we'll see what evolves. It's early stage.
Yeah, I think we might, the name of the company there may be stale. Presumably there was an outfit that had that symbol before. Actually, no, I'm sorry, we're looking for a TSX listed stock called Link, L-I-N-K, and so, yeah, fascinating. I mean, well, that's it. ETFs, that's the beauty of ETFs. I mean, picking a blockchain stock, good luck with that. It's going to be hard.
It's Andy, it's really interesting. I mean, I run a macro fund, which invests across all asset classes and is long short. And we just use ETFs to express it. And so when they look at the holdings, they see SKYY, well, that's cloud-based computing, and HACK, that's cybersecurity, and you can take advantage of a basket without taking the business risk on an individual security.
We'll be right back. It's David Burrows on Market Call.